On week 3, we're going to cover chapter 9, and this chapter answers a couple of questions. So it has real life implications. The way to think about it is this. So when you're doing a project or starting a business, you'd want to know a few things. First of all, what's the minimum level of sales of units you need to break even? So that's an important thing to know. How much does a change in one of your variables impact your NPV? Like if your sales was lower than expected, how big an impact would that have? And then after you start the project, you have an option to change your decision. Can you abandon it if it's not going well, or delay it, or is it just a go or no go? Each of these decisions is analyzed in this chapter. The first one is called a break-even analysis, and we will do that with accounting break-even and NPV. The second one is called the sensitivity analysis. So that will determine how much a change impacts your NPV. And the third one is scenario analysis. And the two options that I talked about here is, the value of these. So option to delay and option to abandon if things are not going so well. Okay, so let's look at the first one we'll do is an accounting break-even. What's the minimum number of sales you must sell, or the minimum of units you must sell in order to have a positive net income? Now this is not net present value, this is accounting net income. And the example says a company sells a unit for $10 a unit, and the cost of production is $4.29 per unit. Okay, so if we look at anything that is per unit, it's going to be a variable cost or revenue. The fixed costs are $1,800 per year, and depreciation is $400 per year. So anything that is time is going to be fixed. So if it's per month, per year, that'll be a fixed cost. And the formula for this is relatively straightforward. They don't take into consideration time value of money or anything like that. The formula says you just use this. Quantity is equal to fixed cost plus depreciation over P minus C. Okay, so Q is break-even quantity. And that's for accounting, for net income. FC is fixed cost. D is depreciation. And both of those would be over a time period. P is selling price per unit. And C is cost to produce a unit. So both of these are a variable. And we're given all of this information, so it's simple to plug it in. Fixed costs are $1,800. Depreciation is $400. The selling price is $10. And the unit cost is $429. Okay, so we work out to a total of $385.3. Okay, so that is the break even, but that's not really how you would, you would start with that, but you would say that the break even is 386 units for a positive net income. Okay, because you can't sell a fractional unit. Okay, so on a test, write both down, write the fractional, and then round it up, and there's your answer.